Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. This first question is from Aaron. He says, my advisor says he can get me 4% income while also focusing on total return. So what does he mean by that? All right, Aaron, let's dive deeper into your advisor's approach of targeting 4% income while also focusing on total return. The dual strategy involves balancing the need for regular income with the desire to preserve and potentially grow your investment portfolio over time. Now, while your advisor talks about achieving 4% income while focusing on total return, it typically means they're employing a strategy that incorporates both interest and dividends, the I in our equation, along with the growth, the G. Right? Ideally, this approach aims to generate enough income from interest and dividends while also allowing the portfolio to grow in value. This is often referred to as a total return strategy with an income orientation. Now here's the catch. Many advisors predominantly focus on total return without explicitly separating income from growth. In these cases, they may use sophisticated software to project your withdrawals and ensure a high probability that your portfolio won't run out of money during your retirement years. This strategy relies on historical data to simulate scenarios where regular withdrawals are sustained by growth in the portfolio. However, it's crucial to understand the distinction between income and growth when it comes to spending from your investments. Growth in the portfolio's value, such as appreciation in stock prices or real estate, doesn't provide usable income unless you sell those assets. Selling assets to fund retirement expenses means dipping into your principal, the original investment amount, with the hopes that the remaining portfolio continues to grow to sustain future withdrawals. This method, often called a hope strategy, minimizes the risk of running out of money but doesn't eliminate it entirely. Now let's talk about eliminating risk as you rightly aspire to. While no investment strategy is entirely risk-free, living off interest and dividends without touching the principal can significantly reduce the risk of depleting your savings income from interest and dividends, right? Excuse me, it can reduce the risk of depleting your savings, right? Now, income from interest and dividends is like a renewable source, right? It continues to replenish itself regularly without needing to sell assets, right? This approach not only provides more predictable cash flow, but also safeguards your principal for potential future needs or, whatever you need it for, right? So Aaron, when your advisor talks about balancing income and total return, they're likely navigating between those two strategies, managing the trade-off between generating sufficient income and preserving long-term growth potential, the long-term growth potential of your investments, right? Ultimately, the choice between minimizing risk through a total return approach with income or seeking to eliminate risk by living solely off interest and dividends depends on your comfort with volatility and your financial goals. In summary, your advisor's approach aims to provide a sustainable income stream while managing the risk of portfolio depletion. Understanding these dynamics will help you make informed decisions about how to structure your retirement investments for both income and security. It's a great question, Aaron. It's a critical aspect of retirement planning that deserves careful consideration. Thanks for the awesome question. And if you would like to send in a question like Aaron did, you can do so by emailing them to poollocke@poollocke.com. So moving on to our second question. This is from Florence. Florence is wondering, is it possible to match the stock market returns in the bond market? All right, Florence, thanks for bringing up this important question. Matching stock market returns in the bond market is indeed possible in certain scenarios, but it involves understanding the dynamics of income generation and potential growth with bonds and bond-like instruments. Typically, bonds and similar instruments offer yields in the range of 6 to 7% currently, which is less than the historical average of 10% for the stock market. So how can your bonds kind of like bridge this gap and potentially reach and even exceed stock market returns? Firstly, let's talk about reinvestment. When you invest in bonds, that yield 6 or 7%, if you reinvest a portion of that income instead of spending it, you can benefit from compounding. Now, over time, this reinvestment can help your portfolio grow and potentially match higher returns. Secondly, the current market conditions play a crucial role. As interest rates fluctuate, bond prices move inversely. So when interest rates decrease, bond prices tend to increase, offering a potential for capital appreciation. Conversely, when rates rise, bond prices may decline. At present, many bonds are kind of trading below their face value, which means they offer higher yields. If you hold these bonds until maturity, they will eventually return to their par value, providing you not only with steady income, but also potential capital gains. For example, consider preferred stocks. They provide fixed dollar dividends rather than percentage-based dividends. If the market price drops below their par value, say from 25 to 22, you still receive the same dollar amount in dividends. As the market price moves back towards par value, you could also realize capital appreciation on top of the income. These strategies illustrate how you can achieve, competitive returns in the bond market while managing risk. By strategically reinvesting income and taking advantage of market fluctuations, you can potentially enhance your overall returns and align them more closely with what you might expect from the stock market, but with reduced volatility and risk. So, Florence, exploring these opportunities in bonds and bond-like instruments can be a prudent approach, especially in today's market environment where discounted prices offer additional growth potential alongside income. It's a great question, Florence. It's a timely topic and highlights the versatility of fixed income investments in a balanced retirement portfolio. Hey, thanks for the awesome questions. As always, if you would like to send in your question, you can do so by emailing them to poollocke@poollocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.